All right, welcome back to the Asset Coach Tax Strategist YouTube channel, and we're excited to have you back. And so today's episode is really going to be focused on one thing and one thing only: passive income. So that as an asset coach and tax strategist, one of the goals that we're looking to do is, besides trying to build up wealth, is how do you build wealth and use that wealth? And that the government and the IRS considers that income. And there's a few different ways that that income can be taxed, whether it's ordinary income taxes like your W-2 wages and on your taxable income on your tax return, or capital gains tax, which is also basically you need to sell an asset and you get a gain, more money than you put into it. And that's taxed not as ordinary income tax, but at capital gains. But passive income is that kind of goal that where you don't have to keep working for it, and that you want to strive for this income that comes to you without the efforts of continuing to put work into it. So for example, if you're a ditch digger, you got to dig ditches to get paid. You're not going to keep getting paid on ditches you dug yesterday and the week before. You're digging a ditch, you're getting paid, right? Obviously, it's a very basic explanation, but at the end of the day, if you dug a ditch, filled it up with water and fish, and then charged people to fish, then that's passive income. You dug a ditch, you turn that ditch into something that created ongoing income, even though you got paid for that digging of the ditch. Okay, so let's go ahead and share my screen here, and we're going to look at an article from Yahoo Finance. Let's see when this article was written, June 12th, so very recently. John Cesar, 12 types of passive income that aren't taxable. Well, first of all, passive income is not a necessary correct number or titling or description of what he's talking about. He's talking about passive income as if you don't have to work for it, so to speak, your earned dollars. But most people think of passive income as residual income. Okay, so that's what most people think about in my description of the ditch digger, filling it with water, put fish in it, charge people to fish. Now you've developed passive income that is also residual, that you don't have to keep doing. Okay, so let's look at 12 types of passive income streams, incomes that you don't need to do your toiling for. Okay, first of all, tax-free municipal bonds. All right, well, what's a municipal bond? Well, what's a bond? Okay, so I don't need to explain what tax-free is, do I? So what's a bond? A bond is just a debt feature. It's a feature where a financial entity or a city or state or country or a company that says, hey, I'm an entity, I need money, you, investor, have money. If you lend me your money, I will give you a interest rate back. Okay, so it's like a promissory note or a debt, but in there it's just structured differently. It's considered a security. Okay, now municipal bonds are exactly what that sounds like. What's a municipality? Right, it's a city, state, government body or entity that is issuing bonds. So what the state it does, it says, hey, we're not getting enough tax revenue. We want to do this project over here, so we're going to need more money than this tax revenue is generating. So would you be willing to lend us money? In return, we're not going to charge you or income taxes on that particular interest. Okay, so that's one way. Okay, typically the interest on municipal bonds is lower than typical corporate bonds because corporate bonds, those interests are taxable. So municipal bonds tend to have a lower interest rate, and it helps the city, right? Because that interest is debt. It's a liability to the city. So if it's lower, it helps them out. but it helps you out because you're not going to be taxed on that income as well. Okay. Now, inheritance. All right. Well, that's passive. You didn't need to do anything for it. But the problem with inheritance is someone has to die in your family for you to get it. But at the end of the day, it's passive. Okay. Now, this also is based on and depending on estate tax laws. So whether federal or your state, and the estate size of the person, the decedent, the person who passed away, if it's going to be tax-free, right? So there could be some sort of taxation, but usually the estate pays that tax or has a way to pay that tax, and you get the net of tax free. Okay. Life insurance proceeds. Yep. Absolutely. Now, again, the downside to this is somebody you know has to pass away, and no different than an inheritance. So you get a good, but there has to be a bad in order to get a good. Okay. Now, also estate tax laws, all that kind of stuff, based on how the insurance policy is written and structured, based on the decedent's estate, depends if there's going to be any other type of taxation on the estate. Okay. But typically this is paid free from income tax. Okay. But there could be an estate tax owed on it. All right. Disability payments. So you become disabled. Now, there's a couple options on this. So some disability payments can be considered taxable. Okay. And this is usually group disabilities that you get through your business. But if you have premiums or you pay for your own premiums and what we call an individual plan, typically those payments become tax-free or non-taxed as income as well. Okay, so it depends on the type of disability policy, where that disability payment's coming from. Now, gifts. Sure, somebody can give you money, and there's exclusions. There's annual gift exclusions. So right now it's $17,000 per person. So what that means is that, let's say you're a wealthy grandma and you want to start giving away money to your grandkids. Well, you can give $17,000 to each grandkid in the year 2023, and you can do this on an annual basis. Now, this does get added to your gift exclusion that you have, which is a large number, and you can be chipping away at that with these little numbers, which is kind of cool. You have five, let's say you have 5 grandkids. You can give $17,000 to each grandkid each year based on whatever the number or the limit is for that year. And it varies each year based on inflation and what the government dictates. Okay, so that's cool. There's also with gifts, there's ways to structure certain gift strategies. So obviously this isn't going to talk about it. This is just giving you a high level. But from a planning perspective, no different than inheritance insurances, there's ways to gift. So essentially an inheritance is a gift. It's money being left to your heirs, right? Alimony, well, was formerly deductible by a payer and taxable to the payee, but now that changed in 2019. After January 1st of that year, 2019, payers could no longer deduct their alimony payments and recipients no longer had to pay tax on them. Bear in mind, however, that some states such as California, shocker, good thing we were all sitting for that one, do not observe federal change and is still tax alimony. Child support, according to the IRS, just as with alimony payments, child support payments are neither deductible to the payer nor taxable to the recipient. Okay. But again, what happens to alimony and tax support and child support? Sorry. You got to get divorced. You got to go through pretty much in some situations, a living hell. A very, very traumatic and emotional event in order for this to occur. But it does occur, so it's good to talk about, so you just know. Roth IRA withdrawals. So yes, Roth IRAs, which are different than traditional IRAs. Traditional IRAs is a taxable account, meaning that when you take your funds out at retirement or pre-retirement, whenever you take money out of your individual retirement account, it is a taxable income, unless it's a Roth IRA. Then, depending on how long you've had the money in there it's at least 5 years or 59 and a half, whichever is longer. What that means is that, let's say you're 58, you make a contribution to your Roth IRA. Well, you can't touch that year's contribution until it's been in there for at least 5 years. Okay. But when you take the money out, you don't pay any interest, capital gains, income tax, or anything on the Roth IRA. Okay. As of now. Disaster mitigation payments. If you suffer through a disaster, your state or local government may provide you with a disaster mitigation payment. These payments are not considered taxable income. Well, that's cool. You know, that's something nice because you just went through a disaster. And I doubt it was very easy to get this payment or this money from the local government or state. So, but again, you went through a traumatic situation. Qualifying adoption reimbursements. In addition to receiving tax credits for qualified adoption expenses, you're also able to exclude from income employer-provided adoption assistance payments. So that's cool. So that may be something you may want to talk to your employer about and see, hey, do you have some kind of assistant payment program that we can do? I actually never heard of this. So this is the first time I've heard of this, but this would be interesting that if you and your significant other are looking to adopt, and you're able to take some kind of deduction out of your paycheck, or the employer is able to have a benefit. So instead of money going to your retirement account, it goes to helping the adoption. I don't know. That's kind of cool. Qualified HSA funding distribution. You're allowed to take one-time distribution from your IRA to an HSA account without having to pay tax on that transfer. Cool. Yeah. And you can go IRA to IRA or retirement account to retirement account, excluding a Roth IRA. So a like taxable account, 401k, 403b, to a traditional IRA to a 401k, 403b. So that's kind of cool. Income in a state with no income tax. Okay, that's just a stupid suggestion, but I guess it's there. It's true. 8 states currently do not tax income that is normally taxable at the federal level. Which are those states? Watch this. Alaska, South Dakota, Nevada, Florida, Texas, Wyoming, Washington, Tennessee. The biggest surprise to me on this list is Washington State. Huge surprise. And when you look at the rest of these states, they're all growing because the people in tax states are moving to, such as Florida and Texas are two of the biggest recipients, with Tennessee being the next big recipient and receiving people leaving blue states for different areas. So I left California and I got a 9% pay raise, 10% pay raise by not having taxes, income tax. Now, cost of living also, but we won't go into that. So how to lower taxes on passive income? Well, you could use a tax deferred account. True, but you're not really lowering. You're just deferring, tax deferred accounts. And if you're deferring taxes today and you believe that taxes will go up tomorrow, meaning not really tomorrow, the next day, but later on in the future when you're going to need this money, then you're really not lowering your tax. You're just deferring it to a larger tax. So that's something that needs to be discussed with a planner and figure out what makes sense here. Hold for the long run. Okay. And the reason why they're saying this is because when you make transactions, that creates capital gains or certain types of income, depending on the length of it. So hold the money. All right. But at some point, again, this is a deferral strategy. We're deferring it to later. Okay. And then tax harvesting. So what this is that where you have a brokerage portfolio, you have some stocks, bonds, mutual funds, ETFs that are doing really well, and you have some gains. And if you sell them, you would have capital gains tax. But then you also have some stocks, bonds, mutual funds, ETFs that haven't done so well, and you have losses. And now those losses, the gains and losses in both of these situations are paper gains and losses, meaning that they don't become a gain, they don't become a loss unless you sell that stock, bond, or mutual fund. Okay. So what do you do? Well, what's the whole thing about investing? Buy low, sell high. So if you sell your losses So let's say you have $10,000 in loss. Okay. Then what you do is you sell your gains to equal that 10,000 loss. So you got your liquidity out of your loss, you got out of that. And then you sold some of your gains, took your profit, and you didn't have to pay taxes on it because the loss that was in the other ones. Okay. It's called tax harvesting. So anyway, so that's an option. But well, anyways, I hope this was helpful with the, it's not one of my most exciting episodes. But at the end of the day, these are important things to know. And really what we do at Terra Firma and being an asset coach and tax strategist, our goal is to try to figure out how do we create tax-free income using various assets. How do we use the IRS guidelines? How do we use the tax code? How do we use the regulations and laws that are been laid out for us very purposely? How do we use those to where you and I can gather income streams out of those assets and minimize our tax liability as best as we can because of our planning? Okay. And so this is an area that we got to look at. These are all assets. And unfortunately, some of the on this list are tragic. You have to go through tragic events, whether somebody dying or a divorce or a disaster, right? I don't want any of those, but it's good to know that if you didn't know that those were situations where you didn't have to pay taxes on, then that's good to know too, right? So because maybe your tax professional doesn't know. I don't know. But anyways, hope you have a great day. Appreciate you joining us. Hey, if you like this content, please feel free to give us a thumbs up. Subscribe if you haven't already subscribed. I'm not sure why you haven't subscribed yet. And get notifications of our upcoming episodes. And if you have any comments or suggestions of topics or things that you want us to talk about or discuss, throw those in the comment section, and we'd love to be able to go through that. So thanks so much. Have a great day. Bye-bye.